the buzz around today is not going to come from the interest rate decision. It will come from the monetary policy statement, much like the ECB of last week, and from the FOMC press conference at 7:30. I'd say the main source of volatility will come from the policy statement, and we will have to see how it plays out. I mean, there is no change in policy or bond purchases expected. The US economy, they say, according to the data, appears to be slowing under labor and supply chain shortages, and Treasury curve is flattened. Potential interest rates into the future have lowered somewhat, but inflation has jumped considerably since the June 16th meeting, the last meeting they had. Inflation came in at 4.9% year over year. It's not quite strong. It's very strong. So I mean, we'll have to look to this statement and see what sort of words this involves. I mean, if they talk about substantial further progress, and whether the data is pointing towards substantial further progress, and they can start beginning the talk about tapering asset purchases, that will be something that is negative for risk, negative for markets, negative for equities, negative for stocks, should prove supportive for the US dollar, supportive for I mean, yields should, if they reduce the amount of bonds that they are buying, it should increase yields, which will increase predictions for interest rates into the future. So I mean, that obviously makes the dollar a more attractive currency to buy if the yield is increased on the dollar. Something that we'll have to look out for in the statement later on today. If the words delta are mentioned in the statement, it is probably likely to be a negative, for the US dollar. It will probably mean positive for risk assets, because if they have to keep monetary policy the same, if they have to keep buying the amount of bonds that they are buying, increasing the supply of money in the economy, in trying to boost growth, trying to boost inflation, trying to boost jobs, that's a positive, and stocks should rally off the back of that, continue the move higher, potentially give a green light for a move higher. The negative today will come from whether they decide to actually speak about tapering asset purchases. Dovish would be, to keep to the same script, to say they're not changing, they're not budging, inflation's transitory. For them to mention that they're still struggling in the labor market, and then should prove positive for dollar bears. I mean, if you do get that example, and you're looking for strength to try and pair against dollar weakness from a dovish outcome tonight, the most hawkish central bank out of the G8 are the RBNZ, the Reserve Bank of New Zealand. They've killed asset purchase and potentially are going to raise rates in the second half of this year, potentially Q4, quicker than any other central bank. So maybe if you get a dovish Fed tonight, then long Kiwi might be the way to go. If you get a hawkish FOMC, a hawkish Fed tonight, hawkish statement, then with the dovish press conference, with the dovish statement out of the ECB last week, maybe euro dollar short with that head and shoulders that is in play. You might get a breakdown through the neckline of that head and shoulders, which would be a good reason to go short. You've got hawkish against dovish, big bearish pattern that everybody's looking at. That'll definitely be a solid trade on the outcome of a hawkish FOMC this evening. If we jump across to the charts, I'm gonna have a quick look at euro dollar and what I'm talking about. Had this wedge I mean, it has trickled out and stuff, but I mean, you kind of at one point, you know, you're like that and you're like this and you're like, where do I draw it from here? And then it's just kind of trickling out. So I mean, we'll have to see how the FOMC plays out later on today. We do have a left shoulder, head, right shoulder, clear neckline across here. Now break down through here. We are testing it, haven't convincingly broke through. A move down below this low down here, below 1750. If I just get on the round number, exactly on the round number there. Yeah, breakthrough there on the back of a hawkish FOMC. Probably a good way to play it. We look at Kiwi. I mean, we just chopped sideways on this. I think back through 70. If we could get back through 70, I think, you know, we've got, you know, touch there. I'd probably disregard this. We got a touch there, and we definitely got a touch here. Definitely a valid level of resistance. You can't start scrolling, you know, back all the way through this. I mean, you got a touch there, a couple of touches there. You know, you can scroll all the way back and find historically how big of a level 70 is. It will be a big level across the historical price action of Kiwi. So hawkish Fed, potentially short euro dollar through 1750. Dovish Fed, potentially long through 70. Should open up further losses in euro dollar for the next couple of weeks, months, potentially even months. And then the opposite could mean longs through 70 and Kiwi, which should open the door to further gains. We might see ourselves back towards 73, even back towards the highs maybe. I think, you know, maybe a punt at Kiwi long term might not be the worst way to play it.